Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Thanks for watching today. I've had a few things happen recently. Of course, there was Fed Chairman Powell speaking at the Jackson Hole event, and he said largely what we said he would be saying, which was no real change, that yes, he was concerned about the impact of raising rates, but economic pain could be experienced in the fight against inflation. He's going to keep hiking rates until the job is done. I think he could go as high as 4.5% or 5.5%, which would really entrench a bear market in equities. You've got to remember, I'm not just bearish equities because of interest rates. People are oversimplifying the situation that the stock market will do whatever the interest rates tells it to. It's much more about the state of the US economy and the level of corporate profitability, of course. And I think both of those have peaked, and there's going to be further downside over the next 12 to 18 months in those areas for a whole lot of reasons that I've previously gone into in detail. One of the more interesting things to happen in the last 2 days, or this week, however, is Elon Musk talking about oil. Basically, he was saying that we do need to have a fossil fuel oil bridge across to when renewables can fully power the world's economy, which of course is probably 100 years away, but in some countries it might be just decades away, where a very large proportion of energy is supplied by renewables. For the moment though, even Elon Musk, who started the electric car craze, is saying we need fossil fuels. Now, in the last several years, no one's liked fossil fuels. Public opinion so against fossil fuels. And that's why governments and companies have done everything they can to certainly appear, if not be, very environment friendly in that regard, which has meant that a whole lot of oil companies haven't been investing in new production or new oil fields because it simply wasn't popular to do so. And a lot of fund managers around the world had stopped investing in fossil fuel companies. So this has led to a rather problematic situation where without new oil field development, the world could be having to ration oil reserves in 10, 15 years' time. For the moment, though, it's more about the consumer felt a lot of pain with the Ukraine-Russian conflict, a lot of pain in terms of the prices and worrying about if supply would be ongoing. Now, in Europe, they're even worried that this winter they may have energy rationing. And if you've ever been in a European winter, energy supply is very important in terms of just keeping warm. So I think there's a very tough winter ahead for Europe. And I think with all of this going on, it's going to make people feel warmer towards oil. So if you like, oil was taboo, the enemy, but now it's going to be seen as more of an enemy that we actually enjoy having around to our house at the moment. So I think this will also lead governments to want to protect their economies with good reserve build-up. So I think reserves in various countries around the world are going to go up by about 5%, oil reserves. That will put a floor under the oil price at around current levels. And I do think there is the possibility for oil to continue to trend lower. I think it has made a major low in recent weeks, to trend higher towards $112 a barrel initially, but probably in the next year or two can go to $150 and maybe even $200 if there began to be a kind of oil reserve build-up competition among various nations. Something to keep in mind on. But I think Elon Musk saying what he said really is an indication of a trend out there in the consumer world not to demonize oil so much. So I think it could be good for oil. In Australia today, we had building approvals. Building approvals were down a whopping 17%, but it's actually worse than that because units were down over 40%. Truly horrific numbers suggesting the residential construction boom is well and truly over. If it isn't over yet, it will be over within the next 12 to 18 months. And we all know that property prices in Australia have been falling for some time. Property prices are down in most capital cities around Australia at the moment. Some individual suburbs in Sydney and Melbourne are down by as much as 10% already. And maybe that's a guide for where the market is going overall in what had to happen as a correction to the rather feverish investment goings on of the last couple of years, where everyone was stretching to buy property while interest rates were at crisis levels. And we know now that interest rates are going to be going up a lot more. I think in Australia too, the RBA could be taking the cash rate to 3.5% or 4.5%. So a lot of hikes to go before we get there. And all of these pressures from central banks around the world are going to tame the economic outlook, and they're certainly going to tame asset prices in general. So I think whilst we've seen some hesitation since Jackson Powell, I think the market is still vulnerable to further downside. The economic data continues to deteriorate mostly. Wherever you look, you get the occasional bright spot. And the price action itself, I think from the recent highs of a week ago or 2 weeks ago in the US stock market, suggests that could have been just the first leg of a sustained downtrend. But we could have 1 or 2 days of strength here or consolidation. But the dominant risk to me in the equity market is at all times to the downside. Thanks very much.